Hook, did you know that in ancient times, soldiers were sometimes paid in salt? That's right, the very word salary originates from the Latin salarium, meaning salt money. This isn't just a linguistic quirk. It's a tiny glimpse into the bizarre, often illogical, and sometimes terrifying history of how we value things and how governments fund themselves. From taxes on windows to the mind-bending reality of negative interest rates, the world of money and finance is far stranger than you could ever imagine. We're about to peel back the layers of these everyday concepts to reveal the hidden truths. Stay until the end because case number 13 will expose a financial reality so profound, it affects every single person on Earth, yet almost no one truly understands it. Intro: Unveiling Financial Secrets. For centuries, humanity has grappled with the concepts of value, exchange, and the collective burden of funding society. Money, in its various forms, has driven empires, sparked revolutions, and shaped our daily lives. Taxes, often seen as a necessary evil, have evolved from simple tributes to complex systems that touch every aspect of our existence. But beneath the surface of these familiar structures lie astonishing facts, bizarre historical anecdotes, and economic paradoxes that challenge everything we think we know. These aren't just dry historical notes. They are profound insights into the psychology, power, and often baffling decisions that have shaped our financial world. By the end of this video, you'll understand why the very foundations of our monetary system are far more precarious and fascinating than any textbook ever dared to explain, and you'll question the stability of what you hold in your wallet. Salt as ancient currency. Let's kick things off with a taste of ancient economics. Before coins and banknotes, many cultures relied on commodities for trade. Salt, a vital preservative and seasoning, was one such commodity. Roman soldiers, stationed far from home, often received part of their pay in salt. This wasn't just a convenient way to transport a valuable resource. It underscored salt's immense worth in a pre-refrigeration era. Its scarcity and necessity made it a universally accepted medium of exchange in many parts of the world. Imagine trying to buy a loaf of bread with a handful of salt today. This historical practice highlights a fundamental truth. Anything can become money if a society agrees it has value and is accepted for transactions. It's a powerful reminder that money's worth is largely a social construct, a collective agreement, rather than an inherent property of the material itself, setting the stage for even stranger financial concepts to come. The peculiar window tax. Moving from ancient commodities to peculiar historical taxes, consider the window tax. Introduced in England and Scotland in the late 17th century, it was a property tax based on the number of windows a house had. The idea was simple. Wealthier people lived in larger houses with more windows, so they would pay more. However, people quickly found a loophole. To avoid the tax, many homeowners bricked up their windows, leaving their homes dark and poorly ventilated. This led to health issues and a distinct architectural style of buildings with blank, bricked-up facades. The tax was eventually repealed in the mid-19th century due to its unpopularity and negative health impact. It's a stark example of how taxation, intended to be fair, can lead to unintended and bizarre consequences, shaping not just economies, but even the very appearance of our cities. It makes you wonder what modern taxes might be inadvertently shaping today. Origin of the dollar sign. The dollar sign, that ubiquitous symbol, is one of the most recognizable financial icons in the world, yet its true origin is shrouded in surprising historical debate. While many believe it comes from the U.S. or perhaps a stylized U.S. abbreviation, one of the most widely accepted theories traces it back to the Spanish peso, specifically the piece of 8. This coin, widely used in the Americas, was often abbreviated as PS in handwritten documents. Over time, scribes would often write the P and S on top of each other, leading to a symbol that resembled a U or an C with a vertical line through it. The two vertical lines we sometimes see might refer to the Pillars of Hercules on the Spanish dollar. This evolution from a practical abbreviation to a global symbol of currency highlights how even the simplest elements of our financial world have complex, often forgotten histories. But what happened next with other currencies, and their symbols shocked everyone, as they too carried hidden stories. The hyperinflation nightmare. Imagine needing a wheelbarrow full of cash just to buy a loaf of bread. This wasn't a dystopian novel. It was the reality during hyperinflation in Weimar Germany in the early 1920s. The Papiermark, Germany's currency, became so worthless that people literally burned banknotes for fuel because they were cheaper than wood. Children played with stacks of money as building blocks. At its peak, inflation reached an astronomical 3.25 million% per month, meaning prices doubled every few hours. This catastrophic economic collapse was fueled by war reparations, excessive money printing, and a loss of public confidence. It demonstrates the fragility of fiat money when its supply is not controlled and public trust erodes. Hyperinflation doesn't just destroy savings, it shatters the very fabric of society, leading to widespread poverty and social unrest. It's a chilling reminder of the delicate balance required to maintain a stable economy. The true cost of printing money. When we think about money, we rarely consider the physical cost of producing it. For central banks, printing banknotes and minting coins is a significant operational expense. While the face value of a $100 bill is, well, $100, the actual cost to print it is only a few cents. However, this cost isn't trivial when you consider the sheer volume of currency in circulation and the need to replace worn-out notes. Beyond the raw materials like cotton linen paper and ink, there are costs for security features, high-tech printing presses, transportation, and distribution. These costs are often borne by the government, which essentially buys the money from the central bank. It's a fascinating paradox. The very medium of exchange requires its own budget to exist. This physical cost is a small fraction of its face value, yet crucial for the system's integrity and a constant, often overlooked, expense. It's not just about the numbers, but the tangible effort behind every note. The paradox of negative interest rates. For generations, we've understood that banks pay you to keep your money with them. That's interest. But what if the bank charged you to hold your money? Welcome to the perplexing world of negative interest rates, a concept that has become a reality in several countries, including Japan and parts of Europe. This isn't just a theoretical exercise. It fundamentally turns traditional finance on its head. Central banks implement negative rates, typically on commercial banks' deposits, to stimulate lending and spending during economic downturns, effectively penalizing banks for hoarding cash. The idea is to push money out into the economy, but it creates a bizarre situation where saving money literally costs you. For ordinary savers, it means eroding returns or even fees on deposits. It forces a fundamental rethink of how we save and invest, challenging the very notion of money's time value. And that's not even the strangest part. Some economists argue this could become the new normal, with profound implications for global wealth. The world of tax havens. The term tax haven often conjures images of tropical islands and secretive billionaires, and while that's part of the picture, the reality is far more complex and pervasive. Tax havens are countries or jurisdictions that offer foreign individuals and businesses minimal or no tax liability in a politically and economically stable environment. They often provide financial secrecy, making it difficult to trace the ultimate owners of assets. While perfectly legal for many, these havens enable multinational corporations and ultra-high net worth individuals to significantly reduce their tax burdens, sometimes shifting profits earned in high-tax countries to low-tax jurisdictions. This practice diverts billions in potential tax revenue from governments worldwide, impacting public services and infrastructure. It highlights a massive disparity in how different entities are taxed, raising ethical questions about fairness and economic equity on a global scale. The sheer volume of wealth held in these havens is truly staggering. The reality of fiat money. For centuries, money was often backed by something tangible, like gold or silver. The idea was that your paper currency could be exchanged for a fixed amount of a precious metal. This is known as the gold standard. However, most major global currencies today, including the US dollar, are fiat money. Fiat money is currency that a government has declared to be legal tender, but it is not backed by a physical commodity. Its value is derived from public trust in the issuing government and the collective agreement that it holds value. In 1971, the U.S. officially ended the convertibility of the dollar to gold, effectively moving the world to a pure fiat system. This means the value of your money is fundamentally based on confidence. If that confidence erodes, as seen in hyperinflation, the money can become worthless. It's a system built on collective belief, a powerful concept that underpins our entire modern economy. The estate tax debate. When a wealthy individual passes away, their assets often become subject to what is commonly known as the death tax, or more formally, the estate tax. This is a tax levied on the net value of a person's assets after their death, before it is distributed to heirs. The estate tax is one of the most contentious topics in taxation. Proponents argue it promotes wealth redistribution, prevents the accumulation of dynastic wealth, and ensures that those who have accumulated significant fortunes contribute back to society. Opponents, however, contend that it's unfair to tax assets that have already been taxed during the deceased's lifetime, calling it double taxation. They also argue it can harm family businesses and farms, forcing heirs to sell assets to pay the tax. The debate over its fairness and economic impact is fierce, making it a recurring battleground in political discourse. Keep watching, because the next fact will uncover another hidden way governments generate revenue from the very act of creating money, changing everything we thought we knew about fiscal policy. Seigniorage, government's hidden profit. Beyond taxes, governments have a lesser-known, yet incredibly powerful, way of generating revenue: seigniorage. This term refers to the profit made by a government by issuing currency. It's the difference between the face value of money and the cost to produce it. For example, if it costs a few cents to print a $100 bill, the government effectively makes nearly $100 in profit from that single note. This profit arises because the government has the exclusive right to create money. When a central bank prints new money, it can then use that money to purchase goods and services, or to buy government bonds, effectively financing government spending without directly levying taxes. While it sounds like a magical money tree, excessive seigniorage can lead to inflation, eroding the value of existing money. It's a subtle but fundamental mechanism of state finance, a hidden lever of power that most citizens are entirely unaware of, yet it influences the economy profoundly. Climax, the global debt illusion. Now, for the ultimate financial secret, the one that underpins our entire global economy and affects every single person, yet remains largely misunderstood: the true nature and scale of global debt. When we hear about national debt, we often imagine it like a household budget: borrow too much, and you're in trouble. But government debt is fundamentally different, and its sheer scale is almost incomprehensible. The total global debt, encompassing government, corporate, and household debt, now stands at over $300 trillion. That's a number so large it's hard to visualize. But here's the mind-blowing part: much of this debt is owed to ourselves. Governments borrow from their own citizens, institutions, and central banks. Central banks, which are often state-owned or controlled, can essentially create money to buy government bonds, effectively lending money into existence. This isn't a simple zero-sum game. The very act of creating and managing this debt is what allows modern economies to function and grow. Without debt, there would be no money, as money is largely created through the process of lending. The paradox is that while individual debt can be crippling, national debt, when managed correctly, can be a tool for investment and economic stability. However, when it spirals out of control, or when confidence in a government's ability to service it falters, the consequences are catastrophic, as seen in economic collapses throughout history. The illusion is that we can ever truly pay off this debt in the traditional sense. Rather, it must be perpetually managed, rolled over, and grown with the economy. The moment the world loses faith in the system that allows this immense debt to exist and be managed, the entire financial edifice could crumble. It's a testament to collective belief, a shared hallucination of value that allows trillions to flow, and that is the most shocking financial reality of all. Call to action. The world of money and taxes is far more intricate and bizarre than most realize, a system built on historical quirks, economic paradoxes, and collective trust. If you found these insights mind-blowing, hit that subscribe button to uncover more hidden truths about the world around us.